Welcome to Breaking News to Trading Moves. Today we're looking at something pretty extraordinary that happened in digital finance. A, uh, a major technical glitch, really, and how it almost instantly caused reactions across related stocks, the main event. PayPal's crypto partner, Paxos, accidentally created, get this, $300 trillion worth of PYUSD.
Yeah, 300 trillion. It's a number that barely computes, right? Bigger than global GDP for a moment there. But importantly, Paxos confirmed they burned it. Massive system mistake.
A truly spectacular slip-up on the ledger. And even though the money wasn't really real in a circulating sense, just the possibility, the sheer scale of that error sends a shiver through the market, doesn't it? Tests that confidence.
It absolutely does. That momentary question mark over who's really in control, it immediately makes capital move. So our goal here is to follow that movement. Figure out who maybe gained a bit of a trust premium as money flowed their way, and conversely, who felt some immediate negative pressure from that headline, that jolt to stablecoin confidence.
Okay, let's start with who benefited right away. It seems like when the market gets spooked by something like this, especially around operational integrity, it tends to fall back on what's familiar, old reliables. We're talking about the legacy payment networks.
Exactly. It's a classic flight to safety. But it's important to see why. This PYUSD thing, it really highlighted that even these governed stablecoins depend entirely on, well, human oversight and the software working perfectly. So investors reacted. They put a higher value almost instantly on the big regulated settlement systems that have been around forever.
And you could see that in the stocks. Visa, ticker V, saw buyers step in pretty quickly. They're kind of the ultimate known quantity in payments, aren't they? Decades of proven, audited reliability, highly regulated.
Right, and not just Visa. MasterCard, ticker MA, got a similar boost. Same logic applies. If you're a merchant, or maybe a big institution, and you start wondering about the stability of a new digital currency, well, a global network like MasterCard, handling payments flawlessly day in, day out, suddenly looks even more attractive.
That perceived reliability gap just widened in a flash. It's quite a dynamic. The operational risk in the new system almost acts like a temporary boost for the old one. Lack of confidence in PYUSD nudges users back towards those established rails.
The market is essentially pricing in that operational control factor. And right then, the legacy players looked like the safest bet for that control.
Okay, so if the legacy players caught that safety bid, what about the crypto space itself? Paradoxically, sometimes bad news or chaotic news in crypto actually leads to more trading activity. Which brings us to our next group, the crypto trading platforms.
Yeah, it seems counterintuitive, but volatility drives volume. Doesn't really matter if it's good news or bad news volatility. A headline about a $300 trillion error might scare some, sure, but it definitely makes people log in, check their accounts, maybe make some trades, either defensive or speculative.
And we saw that potentially helping Coinbase, ticker COIN. They often get a lift in trading volume, staking activity too, when there's a really intense news cycle like this one grabbing headlines.
And it wasn't just the pure crypto exchanges. Think about the broader retail platforms too. Robinhood Markets, ticker HOOD, likely saw more engagement. When a crypto story goes viral, across social media, finance news, retail users tend to jump in, trade the swings. And that boosts order flow, spreads for platforms like UD.
So these companies, they benefit from the sheer increase in activity. The reason for the activity, good, bad, chaotic, is less important in the short term than the fact that people are trading.
Exactly. It's almost mechanical for them. They provide the infrastructure, and they benefit when that infrastructure gets used more, whatever the reason. They monetize the uncertainty, in a way.
Okay. Third group that might have seen some advantage, the competing merchant fintechs. I mean, if PayPal's having a bit of a headache with its branded stablecoin.
It creates an opening for rivals, right? Absolutely. Think about it from a merchant's perspective. They use PayPal for checkout, maybe. Then they see these headlines linking PayPal's brand, even indirectly through PYUSD, to a massive error. Makes them cautious.
And that caution can lead to action. Block, ticker SQ, with its Square ecosystem, seems well-positioned there. Merchants maybe start thinking, Square's checkout and settlement options feel separate from all this stablecoin stuff. They might lean more heavily on that.
Same idea for e-commerce platforms, like Shopify, ticker SHOP sellers using Shopify Payments. Their priority is smooth, stable operations, no drama at the checkout. So if they have payment options other than PYUSD available through Shopify, they might just subtly emphasize those for a while. just to be safe, ensure customer confidence.
It really shows how operational risk for one company can directly create a potential opportunity for competitors to gain a little ground. When trust gets shaky at the point of sale, stability wins.
All right, let's flip the coin now. Who felt the pressure from this Paxos incident? Unsurprisingly, the name most closely tied to the stablecoin felt it first.
Yeah, that would have to be PayPal itself, ticker PYPL. Even though Paxos made the error, the coin is PYUSD, PayPal USD. So, fair or not, the reputational bump lands on PayPal's brand. It immediately brings up questions again about, their oversight of partners, the governance around their stablecoin. And the market reaction doesn't always stop neatly at the company directly involved, does it? Sometimes that pressure spills over onto similar companies just based on the narrative, like MercadoLibre, ticker MELI. Their main business is LATAM e-commerce and fintech, quite different in some ways. But as a big U.S.-listed fintech peer,
It can see some sympathy selling, yeah. It's a generalized reaction. Some traders might use MELI almost as a proxy for that whole fintech integrating crypto theme. So if risk pops up in one part of that sector, sometimes liquidity just pulls back from related names. Even if the direct exposure is minimal, kind of a sell first, analyze later reaction for anything touching digital wallets and crypto futures at that moment.
okay, moving deeper into the crypto infrastructure.
Yeah.
Headlines about stablecoin stability, especially ones this dramatic, tend to spark renewed calls for tighter regulation. Washington pays attention. And then usually puts pressure on the more volatile end of the crypto market, like the miners.
Right. They're less about the specific stablecoin event and more about the potential regulatory fallout. Miners like Marathon Digital, MARA, and Riot Platforms, RIOT, they're often seen as high beta plays on the whole crypto space. Their value is sensitive to the perceived regulatory environment and the future outlook for digital assets overall.
So when a story like the $300 trillion oopsie happens, it gives ammunition to those calling for stricter rules. That regulatory uncertainty, that overhang, tends to weigh down these kinds of stocks.
Exactly. It doesn't matter if they had anything to do with the stablecoin error itself. They represent a purer bet on the crypto ecosystem's future, and regulatory threats cloud that future, so their valuations can get hit harder.
And the last group, feeling some heat. This involves fintechs that aren't primarily crypto companies but do have visible crypto features for consumers.
Yeah, when stablecoin control becomes a big news item, the media spotlight and sometimes regulator focus can broaden out to just crypto and consumer finance generally. Creates a sort of short-term sentiment risk for anyone in that area.
It's like guilt by association almost. Companies that might be mainly about lending or banking, but also let you buy or hold crypto, they can get caught in that downdraft.
We saw some commentary suggesting this could affect sentiment around SoFi Technologies, SOFI, and New Holdings, NU. Their core businesses might be elsewhere, but just having those crypto features visible means a big stablecoin incident can lead to temporary investor caution. Questions about their overall risk profile, potential future compliance burdens.
The market narrative just simplifies for a bit. Crypto equals risk, and any company offering crypto services gets painted with that brush, at least temporarily. Okay, so let's quickly summarize the kinds of trading activity observed around this Paxos event. The material we reviewed pointed to three main ways the market seemed to react across these stocks.
Yeah, the first was described as a relative value approach. Basically, observing trades going long, the defensive names like Visa, V, or MasterCard, MA, while simultaneously going short, PayPal, PYPL. That signals a clear defensive move, right? Favoring the established players over the stablecoin governance questions. And that kind of sentiment shift might last, say, 1 to 3 weeks.
Okay, that makes sense. What was the second?
The second was more event-driven. This involved looking for opportunities to buy companies initially hit by that broad negative reaction, maybe quality fintech names that weren't directly involved buying them on the dip, and then perhaps selling that position later as the market got more clarity, realizing the Paxos error was more isolated.
Right, playing the temporary overreaction. And the third?
The third was simpler, a volume play. This just focused on the exchanges. Watching Coinbase, COIN, or Robinhood, HOOD, for intraday breakouts driven by high volume. That volume comes directly from all the buzz around the crypto headline, fueling more transactions by both retail and institutional players.
Got it. So tracking those flows really gives you a window into market psychology in real time. How quickly risk and trust get priced. And it leaves you with a broader question, doesn't it? Looking ahead, how much are merchants, how much are consumers really going to value rock-solid reliability versus, say, the speed or lower costs potentially offered by some of these newer digital currency options? That trade-off seems key.
This discussion is not financial advice or a recommendation to buy or sell any assets. This information is purely the opinion of the author of the material reviewed.